Hey YouTubers, this is Crazy Horse. So, is the super crash coming? That's what I want to know, since I don't currently own a house in the US and I want to buy one for investment purposes. How long do I have to wait? I'm predicting 2026. What are the house prices going to look like when we get there? I think the super crash is coming. Let me show you the Case-Shiller Home Price Index for the last 24 months compared to the 2006 crash. Let's see if there's any similarities, any differences. Here's the Case-Shiller Home Price Index since 1990. From 1990 to about 2003, we had what's known as the Golden Age. There's a big recession in the US and globally that lasted through most of 1990. So we saw that was when the last big dip in house prices was. The Case-Shiller Price Index is showing the percent change from the previous year, from a year ago. When you look at the Golden Age, you're seeing that the price change per year was 1 to 5%, got up to even 10% around 2001, 2002. So that's a 10% change per year in the house prices. So prices were going up 5% a year, then 10% a year. That's a really strong growth market, so that's why they call it the Golden Age. When we got to 2005, 2006, that jumped up to 15%, which was, the highest we'd seen, and then the bubble burst. So 15% increase over the previous year, but then everything caved in, and then we had over 30% drop in 3 years. It's about a 10 or 15% drop over the previous year for 3 years. So we had about a 30 to 35% drop from 2006, 2009. And then the recovery happened, prices kind of held this, steady. In 2010, 2011, there was a slight drop year over year. And then it didn't really start to grow again until 2013 when there was about a 5% year over year price rise. And that got up to about 10% in 2015. And then dropped back down to 5%. So we saw 5 to 10% growth during that recovery period, which, on a normal basis is not bad. I mean, that's a good growth period. If you're a homeowner, you want to see your house going up 5 to 10% per year in value, and that's what it did from about 2013 right up into the situation in 2020. In 2020, everything went into hyperspeed, and we saw right back up to 20% year-over-year growth, 2021 to 2022. And so then that brought us to June of 2022. So you could call that lockdown period the super growth period, the super growth era, right? Because we had 20% year-over-year growth for about 18 months or 2 years. And then what happened? Then we got to June of 2022, house prices peaked and they started down. And how far down are they going to go? Well, let's look at that right now. So let's take a closer look at the peak, right? So you got the June, July 2006 was the peak. You had 32 months in a row of declining prices. So almost a full 3 years from 2006, 2009, almost full 3 years of declining prices. Didn't reach the full bottom until February of 2012. So 5.5, 6 years went by, we got to the full bottom. It was a 27% price drop. And I think we could be seeing the same thing again in the next 3 years. 27 to 30, even 33, 35% price drop. Okay, so let's take a look. After the July 2006 peak, how quickly did the prices start to drop? So you can see the peak here. These are the two peaks. July 2006 next to the June 2022 peak, right? You can see the decline comparison. All right, so if you look at the decline comparison, you can see the red line is the 2006 decline from the peak, and the gray line here is the current 2022, 2023 decline. So in the first 6 months in 2006, after the July peak, the first 6 months after that peak, prices dropped 1.1%. However, in the current peak from June of 2022 to now, we've had a 4.4% drop. So 4.4 doesn't seem like a lot, but it's 4 times the drop that we had in 2006 in the same 6-month period. 4 times as deep of a drop in the first 6 months after the peak. So I'm not saying that trend will continue and we're going to have a 4 times decline, 4 times super crash, but I'm just saying in those first 6 months after the peak, the decline now is 4 times stronger than the decline in 2006. So where's it going? Are we headed for a super crash? Let's answer that question. So if you look at, where we are now versus where we were in 2006, we had a high peak, year-over-year growth of 15%. Now we're higher. We have a year-over-year growth of 20%, and we're starting to see the same decline. In fact, a stronger decline. So where are we going with that? So if you look at, let's take a current home price like the one I sold outside Orlando for $750,000. If we take a look at that and we look at a market crash over the next 3 years, let's say, from now until 2026, 30% drop, just like we saw from 2006 to 2009, that house will now be worth $525,000. So it'll drop from $750,000 to $525,000. The mortgage payments will probably drop $1,000, $1,500 a month. If interest rates continue up, we could see less of a drop in the mortgage, monthly mortgage payment. But those interest rates, we're in a big inflation period right now. We have a recession coming up. People are getting laid off. I don't expect those interest rates for mortgages to come down. They've already gone up. They're inching back to, I think they're above 7% today as I'm recording this. So I don't expect them to go down much. However, the home prices will come down, and it will make those mortgage payments a bit more affordable, because right now they're way inflated past what most people that would be buying in those areas could afford. So I think we're going to be seeing interest rates continue up for the next short period here, and home prices continue down. So we're going to be it's going to be a balancing act. As the home prices come down, mortgage rates are not going to become more affordable. So some of those houses that are out of reach right now will become more affordable because the actual payment will be less, because the actual mortgage value will be less, but the interest rates are still going to be high. People who had interest rates at 3.1 or 2.8%, 2.9%, like I had, 3.1, are going to be sitting pretty, because everybody who buys a house now for the next few years is going to be paying double that or maybe even triple that. So I'm starting to wish I kind of held my house in Orlando and took out a home equity loan or a line of credit on that house and used it to buy other houses when the prices drop, and I'd still have that house at a low interest rate plus a new house that I buy with that equity, which is what Robert Kiyosaki talks about in his book, Rich Dad, Poor Dad. Keep everything, pull the equity out as it builds equity. Certainly in a rising market, you're building equity, you're paying down the payments, you have a renter in there who's paying down your mortgage. Pull the equity out, buy more homes, rinse and repeat. So I'm kind of thinking maybe I should have kept that house instead of selling it and making $250,000 cash profit. I could have pulled out $200,000 or $240,000 of equity and bought another house when the house prices come down. I'd still be paying a high interest rate for the next house, but I'd have 2 houses instead of 1. So that's something I'll get into in the next video. But I think we're going to be seeing something like a super crash of 30%, maybe higher, 35, 40% crash in home prices from now until 2026. So if you're a seller, hurry up and sell your house. If you're a buyer, you're going to be waiting 3 years. This is Crazy Horse. Thanks for watching.